Nearly 1/5 of the entire United States economy is tied up in healthcare.
Yeah, it's massive.
Right. Just think about the sheer scale of that pie. And today we are looking at, well, the single company that has managed to build a toll booth on almost every lane of that highway, UnitedHealth Group.
Yep.
But what happens when a machine designed to print money suddenly, loses half its profit, gets hacked because of a missing two-factor authentication, and starts intentionally firing its own customers?
Well, you get a corporate crossroads that tests the very definition of too big to fail. We're not just dissecting a business today. I mean, we're analyzing a piece of systemic infrastructure that touches almost everyone's life, whether they realize it or not.
Exactly. And to make sense of how this giant operates and where it's bleeding, right now we're pulling from two incredible sources for this deep dive. First, we have a rigorous academic analysis tracking UnitedHealth Group's financial evolution over an entire decade, so from 2016 through April 2026.
Right, and that gives us the vital historical baseline. It really shows us how they built the empire.
Yeah, and to figure out what that empire is actually worth today, our second source strips away all the human emotion and marketing spin. We're using a purely AI-generated investment report from Deep Value Intelligence, published just days ago in April 2026.
Which is fascinating.
It is. The AI just crunches the cold, hard capital efficiency metrics. But before we reveal the AI's verdict on whether this company is a buy, we have to map out the machine itself.
For sure. To understand UNH, you have to break the illusion that it's just a health insurance company. They operate a highly sophisticated dual-platform model.
Right.
So think of it as two massive engines. On one side, you have UnitedHealthcare. That is the traditional insurance vehicle. They collect the premiums from employers, individuals, and the government, taking on the underlying financial risk if people get sick.
Yeah, that's the engine everyone knows.
Exactly. But the second engine is the real secret sauce, and that's Optum. Optum is their clinical innovation, pharmacy, and data analytics arm.
Oh, wow. So they do everything.
Pretty much. They actually employ the doctors, providing the care, they manage the prescription drug benefits, and they run the massive data networks that process medical claims. They even sell those data and pharmacy services to competing insurance companies.
That's wild.
Right. The strategic brilliance here is that while the insurance side is vulnerable to unpredictable spikes in medical costs, Optum provides this steady, high-margin, service-oriented revenue stream.
Okay, let's unpack this. Because from 2016 to 2025, running those two engines simultaneously made this company look absolutely unstoppable. I mean, up until they hit a very hard wall.
Yeah. The academic analysis details an era of relentless, almost aggressive expansion. In 2016, UnitedHealth Group brought in $184.8 billion in total revenue. By the end of 2025, that top-line revenue exploded to over $447 billion.
Good grief.
Yeah. Doubling revenue at that mega-cap scale is a staggering feat of corporate engineering.
It's wild. It reminds me of, like, the ultimate vertically integrated airline. Imagine an airline that doesn't just sell you the ticket. They also own the airports you fly out of. And they employ the baggage handlers and mechanics, and they own the refineries that make the jet fuel. By owning UnitedHealthcare and Optum, you are capturing a slice of the revenue at every single stage of the patient's journey. The money effectively stays in the family.
That vertical integration is exactly what created their legendary economic moat. When you control the payment and the provision of care, you theoretically control your own destiny.
But I have to push back on that theory based on the 2025 numbers, because if this model is so brilliantly integrated and they capture all this revenue, how on earth did their net income fall off a cliff?
What?
Like, the data shows net income hit a peak of $22.4 billion in 2023. By 2025, 2 years later, it crashed to just $12.1 billion. That is a 46% drop. If you own the whole airport and the fuel, how are you losing half your profit while your revenue goes up?
What's fascinating here is that a wide economic moat does not grant you immunity from margin compression. Revenue is growing, sure, but the underlying cost of delivering that care was accelerating much faster than they anticipated. Yeah, in the managed care world, the absolute most critical metric you have to watch is the medical care ratio, or MCR.
Right. Let's break that down for the listener really quick. The MCR is basically just the percentage of premium dollars the company actually has to spend paying for medical care, right? So if I pay you $100 a month for insurance and my medical bills cost you $80, your MCR is 80% and you keep $20.
That's the exact mechanism. So naturally, the lower the MCR, the better it is for the company's profit margins. In 2023, UNH's medical care ratio was a very healthy 83.2%. But then, the post-pandemic medical inflation really started to bite.
Oh, right. Everyone going back to the doctor.
Exactly. Hospitals and providers demanded massive price increases to cover their own rising labor costs, and patients started utilizing significantly more medical services, catching up on delayed surgeries and treatments.
So the cost of the jet fuel skyrocketed.
Precisely. By 2025, that MCR had spiked to 88.9% on an adjusted basis. And when you are dealing with a revenue base of hundreds of billions of dollars, a 5% increase in your MCR doesn't just pinch. I mean, it wipes out billions in pure net income.
But medical inflation is just a math problem. The academic paper makes it very clear that they weren't just fighting inflation. They got hit by a perfect storm of external shocks that tested whether this massive infrastructure was actually secure.
Yeah, it was brutal.
Which brings us to February 2024. The lightning strike.
The Change Healthcare ransomware attack.
I mean, think about the portal you use to log into your work email or your bank account. You probably get a text code on your phone, right? Basic two-factor authentication.
Standard stuff.
Right. Now realize that Change Healthcare, which acts as the central financial nervous system for a massive chunk of the U.S. health system, processing claims between doctors and insurance companies, had a remote access portal without that basic safeguard.
The vulnerability was shocking, especially for a subsidiary of Optum dealing with the most sensitive data imaginable.
It's insane. A senator, quoted in the source, called it failing cybersecurity 101. Hackers breached a Citrix portal using compromised credentials, and because there was no second layer of security, they just walked right in and encrypted the system.
Yeah.
192.7 million individuals had their data affected. We are talking about the largest healthcare data breach in history.
And the operational fallout was catastrophic, not just for UNH, but for the country. Because Change Healthcare is the pipeline that verifies insurance eligibility and processes payments, clinics and hospitals across America suddenly couldn't get paid.
Wow.
They were providing care but had no way to bill for it.
Small practices were literally days away from missing payroll and declaring bankruptcy.
To prevent a localized collapse of the healthcare system, UnitedHealth Group had to step in as the lender of last resort. They advanced over $2 billion in emergency funding to providers just to keep the lights on in clinics across the country.
$2 billion?
Yeah. Meanwhile, Optum Insight suffered an $867 million loss in business disruption directly from the attack in 2024 alone.
So you have a $2 billion bleeding wound, your internal systems are frozen, you're losing money on medical inflation, and right in the middle of this chaos, federal regulators decide it's time to change the rules of the game.
Yeah, and look, I want to be very clear here. We are just neutrally reporting the source materials analysis on these policies without taking any political side whatsoever. But purely from a financial data standpoint, the policies coming out of Washington during this window fundamentally altered the math for insurance companies.
Okay, what were the policies?
The academic analysis highlights two major headwinds. There were Biden-era reductions in Medicare Advantage-based funding rates and the implementation of the Inflation Reduction Act, or the IRA.
How did the IRA specifically shift the ground under their feet?
Well, it came down to how the IRA restructured Medicare Part D, which is the prescription drug benefit. Under the old rules, once a patient's medication costs hit a certain catastrophic threshold, the federal government stepped in and footed the vast majority of the bill for those ultra-expensive drugs.
Got it. So like a built-in safety net for the insurance company.
Exactly.
Yeah.
But the IRA flipped that dynamic. It structurally shifted a massive portion of that financial risk away from the government and directly onto the payers, like UnitedHealthcare.
Oh, wow.
Yeah. Suddenly, their safety net was gone, and they were on the hooks for those high-tier costs. They had to frantically reevaluate their pricing models and benefit designs to absorb risk they previously didn't have to worry about.
So what does this all mean? You lose 46% of your profit, you suffer the worst cyber attack in your industry's history, you loan out billions to keep hospitals afloat, and structural federal policy changes evaporate your Medicare safety nets. How do you pull a company out of the tailspin like that?
You do it by shrinking.
Really?
Yeah, you cannot grow your way out of structural unprofitability. Surviving this perfect storm required a ruthless pivot away from their decade-long strategy of grabbing market share at all costs.
Which is the fascinating pivot we see in the Q1 2026 results.
Yeah.
The new mantra is clearly margin over membership. In the first quarter of 2026, they pulled in $111.7 billion in revenue. But more importantly, they forced that medical care ratio back down from nearly 89% to a much more sustainable 83.9%. Right. And they achieved that improvement by intentionally firing their own customers.
It's a textbook stabilization maneuver.
Yeah.
When your MCR is dangerously high, it means specific pools of policyholders are costing you significantly more in medical care than they are paying you in premiums.
So you just drop the bad pools?
Exactly.
They shed 80,000 members in their employer and individual segment alone. They looked at underperforming contracts in unprofitable regional markets and essentially walked away. But shedding the dead weight only stops the bleeding. To actually cure the underlying cost disease, they made a massive futuristic bet on artificial intelligence.
Right. They allocated $1.5 billion purely toward AI and machine learning integration for 2026, with another $1.5 billion slated for 2027. And management isn't doing this for a PR boost. I mean, they are actively targeting $1 billion in pure operating cost reductions just in this calendar year.
Over 80% of member service calls are now being routed through AI resolution tools. But the detail that really stood out to me in the sources was what they did with Optum Health's provider groups. They forcibly consolidated them from using 18 different electronic medical record systems down to just 3.
And that consolidation is the critical prerequisite for AI.
Right, because an AI algorithm is entirely dependent on the data it consumes. If you have patient files scattered across 18 different software languages, an AI trying to read that data is just going to hallucinate or break.
Exactly.
By forcing everyone onto 3 standardized systems, UNH's new AI tools can suddenly ingest, analyze, and automate millions of patient files globally at lightning speed. You drastically reduce the need for human administrators to process routine claims. That is where that $1 billion in savings originates.
Yeah, and to oversee this massive company-wide rewiring, the board brought back Stephen Hemsley as CEO and chairman. He is the original architect of UNH's mega-growth era.
The old...
Right. They also fortified the board of directors with serious healthcare heavyweights, including former FDA Commissioner Scott Gottlieb, which really signaled to Washington that they are taking compliance and restructuring seriously.
They even tied Hemsley's hands to the mast with his compensation. He received what the source calls a cliff vesting stock option grant, which basically means he gets no annual bonus. He only gets paid out if the company's stock hits specific long-term recovery targets down the road. If the multi-year AI pivot fails, he gets nothing.
It's an aggressive alignment of executive incentives with shareholder interests.
Wall Street obviously loved that cost-cutting, AI-driven narrative. I mean, the stock popped 9% after those Q1 earnings. But if you look under the hood using that deep value intelligence AI report we have, the actual intrinsic value of the company tells a completely different story. It's not actually a $314 stock.
No, that AI investment report is incredibly sobering, because while human traders get excited about a 9% bump in AI buzzwords, the deep value AI simply look at how efficiently UnitedHealth Group utilizes capital.
Let's translate some of these metrics for the listener, starting with ROIC.
Sure. So ROIC, or return on invested capital, is one of the most revealing metrics in finance. It simply asks, for every dollar a company plows back into its own business to grow, how much actual profit does it squeeze out? The AI calculated UNH's ROIC at approximately 11.2%, with its return on equity sitting around 12.8%.
Okay, so if I give them $1 to invest in new clinics or software, they generate about 11 cents of return.
Correct. In the investment world, 11% is solid. It's profitable. But it is not exceptional. You aren't looking at the 30 or 40% returns you see with dominant tech monopolies like Apple or Visa. Because of this, the AI applied Peter Lynch's famous investment framework and categorized UNH as a stalwart.
A stalwart. It's a massive, slow-moving, steady compounder. It's a blue-chip company that offers stability, but it is never going to double or triple your money overnight.
Right. And the fundamental rule of investing in a stalwart is that valuation is everything. Because the underlying growth is slow, if you overpay for the stock up front, it could take you a decade just to break even. You cannot afford to pay a massive premium for 11% returns.
Which brings us to the valuation reality check. At the time this AI report was generated in mid-April 2026, UNH stock is trading right around $314 a share, giving it a price-to-earnings ratio of nearly 24. But the AI ran something called the Buffett owner earnings calculation.
Yeah, that's a crucial metric. Owner earnings strips away all the complex accounting fictions and depreciation schedules. It basically calculates the raw, tangible cash the business generates for its owners after subtracting the money they absolutely must spend just to maintain their current operations and infrastructure.
And when the AI looked at that pure cash generation, it calculated the actual intrinsic value of UNH at just $204 a share. Even their discounted cash flow models, which try to project all future cash out over a decade, only brought the average value up to $294.
The chasm between the market asking price of $314 and the intrinsic business value of $204 represents a complete lack of a margin of safety.
It's like you're looking to buy a top-tier luxury armored truck. It's an amazing asset, highly defensible, but you just found out the manufacturer left the master key under the floor mat and it was robbed. That's your cyber attack vulnerability.
Yeah.
The dealer changed the locks and tightened security, but they are still demanding the full brand new retail price for it. You're paying a premium price for a compromised asset, and you're getting absolutely no discount for the risk you're taking on.
That analogy perfectly captures the tension. And what's revealing is that the institutional smart money, the billionaire hedge fund managers tracked in the report, are reacting to this exact dynamic in very different ways.
The divergences are wild.
They really are. Warren Buffett is holding his stake completely steady. He loves the wide moat and the systemic scale, and his timeline is essentially infinite, so he's willing to wait out the turbulence. Steve Cohen's Point 72 went the opposite direction. They heavily increased their stake, actively betting that Hemsley's turnaround and the AI efficiencies will quickly push the stock higher.
But then you have Michael Burry, the guy famous for the big short. He looked at the 11% returns, looked at the $314 price tag, looked at the risks, and he completely exited his position. He sold out.
He determined the risk-to-reward ratio was entirely broken, which leads to the Deep Value Intelligence AI's ultimate verdict. After analyzing the capital efficiency, the cyber fallout, and the turnaround data, the AI formally labeled UNH as a watch H, or, as noted in the original Chinese text of the report, Guanwang.
Guanwang, wait and see. The AI is telling you the ideal entry point is absolutely not $314. You want to sit on your hands and wait for the market to offer you a price in the $240 to $270 range before pulling the trigger.
It is a mathematically driven recommendation for patience. You wait for a price that actually provides a margin of safety against the company's medium-tier capital returns and the ongoing external threats.
And we really need to talk about those external threats, because there is one more massive variable keeping that watch status locked firmly in place. It's the looming shadow of the federal government. I mean, you simply don't control nearly a fifth of the GDP's primary sector without attracting incredibly aggressive oversight.
Oh, absolutely. The regulatory dark clouds are arguably the most significant long-term risk to UNH's valuation. The academic source outlines two ongoing, highly sensitive Department of Justice investigations. First, there's a criminal probe into a billing practice known as upcoding.
Upcoding. So for those unfamiliar, the government pays Medicare Advantage insurers a set amount per patient, but they pay more if the patient has complex, severe health conditions. So the accusation of upcoding is that the insurance company is digging through medical records to document patients as appearing much sicker than they actually are, specifically to trigger higher payouts from the government.
Exactly.
Yeah.
The DOJ is investigating whether UNH systematically utilized its data analytics to alter coding practices and artificially inflate government reimbursements. And secondly, the government has launched a major antitrust investigation targeting the very core of their business model, which is the vertical integration between UnitedHealthcare and Optum.
The airline owning the airports.
Precisely. Regulators are investigating whether UNH uses its massive insurance dominance to unfairly steer patients toward its own Optum clinics and pharmacies, deliberately starving out independent doctors and competitors. If we connect them to the bigger picture, the greatest existential threat to UnitedHealth Group is not a competitor.
Right. There isn't another healthcare company on earth that can truly compete with them on scale.
No. The greatest threat is the possibility of the government stepping in and altering the very rules of how they are allowed to generate a profit.
Wow.
Yeah. If the DOJ forces a structural breakup of Optum and UnitedHealthcare, or if Congress fundamentally overhauls how Medicare Advantage calculates its payments, that 11% return on invested capital could shrink even further. The economic moat is deep, but the federal government ultimately owns the water supply.
That is the perfect way to frame it. Okay, let's bring all these threads together. UNH is a fascinating, almost intimidating case study. It's an undeniable healthcare juggernaut that has just navigated a historic, multi-billion-dollar cyber attack, a barrage of shifting federal policies and shrinking profit margins. And now it is betting its entire future on shedding unprofitable members and spending billions on an AI-driven efficiency overhaul to get back to its glory days. But as the AI investment report so clearly lays out, just because a company is dominant doesn't mean its stock is at a price with a margin of safety. And before we go, just a quick message for you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
And I want to leave you with one final thought to mull over today. UnitedHealth Group is spending over $1 billion right now to implement AI, to optimize their claims, automate their medical records, and maximize their corporate efficiencies. And today, we used a different AI to analyze their financial viability and tell us if they're a good investment. It makes you wonder, within just a few short years, will the entire American healthcare system just be insurance algorithms, negotiating with hospital algorithms, with our actual human health caught somewhere in the middle?